Just wow, that's my reaction to HIMS earnings, but also to the market we've been seeing in the past few months here today. But nevertheless, HIMS and Hers just released their Q1 earnings 2022, had superior earnings, raised their guidance, smashed expectations. So today I'm gonna take you through the entire earnings report. We're gonna dissect it. We're gonna have a look at what have they been doing, what have they reported, what's the outlook gonna say, and how does it affect, the valuation, the current stock price, and how much of an undervaluation do we have at the moment. This is the first page here, is the key summary of the earnings. What jumps into my eyes straight away is the $101 million revenue, which is the first time that HIMS and Hers has broken through the $100 million of revenue per quarter. It represents a 94% increase from prior year, which includes 90% recurring subscription revenue of prior year subscribers. Also very important to notice, as we will see later on, that they will keep adding to the existing subscriber base to further increase that revenue and have an exponential growth here, economics of scale, but also revenue growth as such, obviously improving margin and improving the net results. The patient impact, so 710,000 subscribers now, more than 100,000 from prior quarter. So just gained 101,000 new subscribers in the quarter. We're still sitting around a 74% gross margin. We'll look into that a little bit later. That dropped slightly, but it was to be expected with the macro headwinds that we have seen in the market. Supply chain issues, increased prices for transportation, but also them venturing into more the wholesale of the side of the business, which obviously has lower margins as such as well. But a major beat here on the adjusted EBITDA margin, only negative 6%, which was way less last quarter. So we'll have to see what causes that. But overall, obviously, huge success for this factor. Two things that during the earnings call they've been calling out specifically was obviously the rapid organic adoption of their mobile app platform, which has just been released in the quarter. So 60% organic adoption here. But then also they have 2 fulfillment centers in Arizona and in Ohio, which have been responsible for over 50% of the order fulfillments. So that's a huge contributor to them keeping up the high margin and actually producing economics of scale going forward. So as we mentioned, obviously the app was a huge step into the right direction. That is going to be a differentiator for HIMS and Hers going forward from more the traditional healthcare and also the other telehealth companies out there, as this is obviously very tailored to the millennial and Gen Z generation, which want to use an app, a nicely to use app where they contact their health practitioner, where they make their orders and where they keep up to date with things. They don't want to go into a doctor's office, fill out a paper form or things like that. That's just not what younger people are preferring. So them putting out this platform here is a huge step into the right direction, adopting that model that they're looking for even further, increasing the engagement of the millennials and Gen Zs, and making just building that whole brand around HIMS and Hers himself even further. So a huge step here, and was a huge success as well, as called out by the CEO on the call. So yeah, these are the 3 bubbles here, being the differentiator of HIMS and Hers, creating a unique experience for the users. So we have a trusted brand, which obviously they're still young, but they keep putting up their brand recognition. They have huge views on TikTok. They keep building out that social media presence and brand building amongst millennials and Gen Zs. Then obviously, as I touched on, the digital experience, which is very unique and very tailored to that younger generation, which will bring the majority of revenue going forward 10, 20, 30 years. And then also the high frequency engagement. And as we've seen through news releases, they've partnered up with a number of big players out there, CVS, but also Walmart, obviously cutting into their gross margin, as the wholesale revenue will be taking off a fee for them to actually put them on the shelves and so on. But definitely an important factor to get into retail, to be seen by other people, not just through the digital channels, but also to be seen by other people just by walking into the store and actually taking a look at the brand and getting to know it. So as I mentioned before, 2 fulfillment centers, Ohio and in Arizona, they have been contributing hugely to the success of HIMS and HERS being able to quickly fulfill orders, being able to fulfill orders themselves, reducing cost and driving economics of scale therefore. And it has been a huge success this quarter. 50% plus of the total order volume was fulfilled by these 2 centers, which is only expected to be increasing even more going forward. So this was something they specifically called out in the earnings call, that they're very proud of the way it works, and this is just like an integration into their whole seamless experience, where they're actually trying to get things very quickly to the customers while they're engaging with the health practitioner on the app, then ordering the stuff, and it gets distributed pretty quickly. So the automation factor here, economics of scale, but also just controlling your own product and really making sure the quality is right and it gets delivered within time frame. So that is something very important, and it's been called out over and over again. And I think that's also one of the reasons why we haven't seen a significant drop in the gross margin, still sitting at 74%, which was arguably higher, 76, 77. But there was fears that this would even drop even further given the macroeconomic situation we're in right now. And then here, looking at these 2 charts, obviously 2 of my favorite charts, that's what we want to see. Rapid exponential revenue growth on the left side, giving you a compounded annual growth rate of around 117% since 2018. That number is obviously really, really high. I'm expecting that to be dropping off quite significantly, as we go into the next few years. But nevertheless, the absolute numbers will obviously still increase. And my estimates, that they're reaching around $1 billion of revenue in around 2025. And I think they're on track for that. And they've actually raised their guidance for revenue this year, as we're going to see later on. And yeah, gross margin, obviously they had a huge increase. Now it seemed that type of range, the 70% plus range, anything from 74, 75, 76%, that seems to be where they're plateauing at the moment. As they're trying to obviously scale further, but obviously it's already a pretty good margin. If you can stay at that margin and reduce your operating expenses, you're looking at a really, really healthy profit, right? Like you can expect going forward a 20% EBIT margin, which would be fantastic as such if they bring down those operating costs. So I don't really see it as a concern that they're kind of plateauing, as the margin is very healthy, and even in challenging times right now, they haven't significantly, at least yet, not significantly dropped their margins. We're looking at Q1 2022, as I said before, at a 74%, which is the margin from 2020. So on this slide is very important as well. So obviously huge customer growth, seen an explosion during the COVID time here, doubling up their subscription base to 609,000 end of year 2021. And now they've added another 100K on top of that. But what's more important, that obviously they have the subscription business model, which is a fantastic model, as you don't just need to create new revenue each year, which has to be more than the previous year. But some of that revenue, which is here in that color, is the recurring revenue from customers acquired years back. So now we've seen the compound effect of years of customer accumulation. Now we're seeing that almost half of last year's revenue was recurring revenue. So you can only expect that to be growing even further, whilst they're also growing this part here, which is the new revenue, as they retain around 90% of that revenue, but it still grows as such, because other customers will get other services as well. Whilst here we have a rapid customer base growth, which will generate new revenue. So that is obviously impressive here. As you can see, 81% CAGR on that recurring revenue, 67% on the new one. So yeah, roughly over 70% growth year on year, and this is not expected to slow down anytime soon. As we mentioned before, really significantly milestone hit here with $100 million revenue for the quarter, for one quarter, having also raised their guidance for the full year now. And obviously subscriptions now hitting a new all-time high at over 700,000 as well, which has just been seen that, you know, there's all the positive impacts of creating the ongoing creation of the brand, building the brand via social media and as such, but then also putting out that platform for the mobile platform, which you can see that there's a significant jump here if you compare that to other quarters. So that has definitely had a huge impact on the customer growth, and I think that this will have a way longer lasting impact going forward, as well as if you build a sticky platform, people will get used to it, will stay on it, and then will actually order more, and they won't switch necessarily over, because it makes it harder to switch once you've got set up everything, once you have your trusted health protection on your app and you're happy with it. Why would you swap all the time? It's kind of like, you know, it's annoying and time consuming as well. So it makes it so that the revenue becomes stickier as well. This is an important slide from an investor's point of view, as you obviously want to see them making profits going forward, because, you know, any money you invest in, you can only really get a real return as soon as they're producing free cash flow that can be redistributed to you via share buybacks, dividends, or, you know, just general stock price increase as the company expands and the market cap expands. So yeah, they're saying, they've been talking about here a line of sight for break even adjusted EBITDA margin, which, you know, is true. If you look at the actual numbers, it has been steadily reducing, and they've actually said for 2022 they're actually expecting quite a low negative EBITDA loss, or adjusted EBITDA loss, which, you know, they've set line of sight of adjusted EBITDA break even, or, you know, profit there, but they haven't really given us a concrete number of years. Obviously they don't want to overpromise here. They haven't said, you know, in 2023 we're looking at a profit, but it sounded like that there is a possibility here that even next year on an adjusted EBITDA margin we might be able to see positive numbers. It's yet to be seen. In my base model, I've kind of brought them around the break-even point and then making a small profit in 2024, but then exponentially increasing in 2025 and 2026 as well. So yeah, yet to be seen, but obviously making good progress into that direction. We have no debt, as we know, which is yeah, very helpful in this type of environment. So no risk of bankruptcy here. Strong cash flow position as well. So haven't really talked about any. I saw a few comments of, you know, cash burn rate and the need for raising new capital. They have a strong cash position which stayed relatively stable, and they haven't really talked about the need for a capital raise. So that's yet to be seen. And yeah, the improvement comes obviously from the abilities to scale, but also from the new efficiency gains from their platform. So with that, we're looking into the 2022 outlook. Very important, very good in this type of market to actually raise your expectations, whilst other big companies are dropping their expectations, lowering them, and based on that dropping 10 to 30 to 40% in their stock price in just one day after earnings. What we've seen from HIMS is actually raising expectations based on that strong Q1 quarter. So now been looking at $410 to $425 million for the entire year of 2022 in terms of revenue. For the next quarter, we're expecting a similar number that we have right now, so just above 100 million. So yeah, if you add that up, so basically you go to, you know, well above 400, but like early 400 million, which previously I have thought that they would reach a number closer to 375. At least that's what I put into my model. So it's good to see that, you know, they're actually increasing that, which will have an impact. Obviously, if you compound at $400, it will go differently than, or the calculation will end up differently than on 375. It's not a huge impact as such, so, but it's definitely good to see them having so much confidence into their business model and their management abilities that they're actually raising expectations and guidance in this type of challenging environment where you should be more careful actually to not overpromise so that your stock price doesn't tank. They basically said, no, we are confident enough to raise the expectations and guidance here, and that would equate to a 51 to 56% revenue growth, obviously slowing down here as the numbers get bigger, but pretty much reaching almost $500 million here is a really good progress. And adjusted EBITDA, we're just looking at just around the same type of loss, a little bit less for next quarter, same as this quarter pretty much. So yeah, looking at minus 30 to minus $20 million, which is less as we obviously have increased here the revenue. So yeah, it's yet to be seen what the actual number will be, but we'll look through the numbers very shortly to see how they actually stack up. So in terms of the numbers, so let's head into the detail a little bit more. Something important that I've noticed here is we're starting off the year with relatively low stock-based compensation. So it might be that most of what was promised to employees and most of the new big hiring had happened in Q1 of 2021 and Q3 as well. So it's yet to be seen if that trend continues and if we do see lower stock-based compensation. But that's obviously a huge factor here, as as employees getting promised more and more stock, you getting less and less as a result of dilution of your existing ownership. So you want to see that going down. We definitely don't want the same level as 2021, as it was quite high overall. So hopefully we will stay around, below 10 million at least for each quarter. But yeah, it's yet to be seen. Obviously revenue is increasing here, so if we can decrease that number, that will also have a positive impact on adjusted EBITDA. But if we calculate everything together, they're basically expecting more revenue, but then still around 20 to 30 million dollar of negative EBITDA. So that means that there might be still something here to come, or somewhere else which we don't know yet. But there's only so many options here. So stock-based compensation will be one of the more higher ones, and based on the estimates, that would mean that it actually should increase going forward, as the revenue will be sitting at around 410 million for this year. So yeah, it would be interesting to see why they're spending so much there, and the expectations as well. And we haven't really in the earnings calls, they haven't really talked about it at all. I haven't really heard any questions around that. So yeah, it would be interesting to see what they say in the next earnings call. So then from their press release, I've got the actual P&L, the profit and loss statement here for the 3 months. So we see the revenue here nicely coming in at 101. Gross margin, as we said, reduced at 74%, not 77 as it was in March 21. But I mean, it's still quite high, and obviously still leads to higher profit as the revenue increases. And then what's interesting to see is, so we've basically doubled revenue. We haven't quite doubled marketing expense, but it's kind of almost in line with revenue growth, a little bit less than that. But selling, general and admin expenses, that have come down massively so far. That could have to do something with the public going public and stuff like that. I haven't really looked into the detailed numbers here, but it's good to see that overall operating expenses are only 91 in total, compared to 88, which is slightly more, but we're looking at double the revenue for this quarter. I don't really know how I should, take those numbers. I mean, marketing slightly less, but still almost going in line with revenue. And obviously going forward, we can't have that happening. We can't have 50% of revenue being marketing expenses. That will just eat away all the profits, having us left with nothing here. Loss from operation now sitting at 16, which is obviously better than last year, which was almost 50 million. But we can't just have the marketing expenses keep increasing with revenue, as that would just eat away all the profits and would make that super high gross margin here actually really not any impressive at all if it gets eaten away in a different place. So that's one of the key things that I look out for. So let's see how that develops over the year. But yeah, revenue and gross margin obviously very nice. Yeah, other than that, nothing really that we need to talk about here. And we look at their balance sheet, not much has changed. Still, cash is slightly reduced. Overall current assets now, slightly less than last quarter, but also current liabilities have reduced. Net asset movement wasn't really that much at all. They've basically been paying off more liabilities than they have cash, so it might be a timing issue as well. But other than that, there's not any significant moves here in terms of that. And then earnout payable has gone down, which is good. So only 13 million left here. And yeah, cash and short-term investments still sitting at a really good balance here. Almost so over 200 million, which obviously will help them funding the business. So haven't really seen any need for capital raise at this stage. And they are looking good at the moment, as we can see that current assets is way higher than, it's almost more than 5 times than current liabilities. So they've been looking good at this rate to keep the business running. Now we're coming to the fun part. I mean, not so much fun for most of people, but actually fun part if you're a long-term investor, because what has the stock done based on those earnings, on those fabulous earnings? So obviously it actually had gone up quite significantly, actually over 10%, but then it's been steadily dropping down again, and now we're down for the day at 6.5%, down to below 350 a share. Market cap now sitting at $715 million. I mean, if you believe in the long-term vision here, if you have that time frame to wait out and let the market do whatever it wants to do in the short term, overlook those macro factors, focus on the companies, focus on their really, really good results here and the growth trajectory going forward. If you have your time horizon longer than 2026, 27, 28, there's a high probability here, if they keep going and keep executing like this, that you will make a lot of money with these current prices especially. So yeah, as the stock price goes down, you actually have to be happy if you're a long-term investor, because you're basically buying the company at such a low valuation that even at current levels for what they're projecting going forward, we're looking already at a double up from here. And then obviously going forward, as they can keep catching more of that market share of the whole telehealth industry, which is expected to grow over 30% year on year until 2030 basically. If they can grab that market share with them as they're building out their brand right now while it's still kind of early, I mean, there's a huge opportunity here to get that company to 5, 10, $15 billion valuation quite easily, to be honest. And I really like the management when I listen to them. Really seems like they're young, they're hungry, they have their shit together basically. CEO and CFO really liked how they've been talking about the business and how they kind of managing everything, how they had basically explanations to everything. They knew their numbers, they knew what's going on, and they had a pretty good overview of the business and where it's going as well. And that was really important for me to hear. It got me a lot of confidence as well. So yeah, let me know what you think about HIMS and HERS, what you think about these earnings. If you're buying more on the dip here, I mean, I know a few of you are definitely buying more here, but let me know what you're doing. I will pick up a few more shares as well, I think, in the upcoming weeks. I don't think the market is gonna U-turn that quickly, at all. So I think we'll have some time here to pick up some shares at a really, really good, reasonable price. So yeah, let me know in the comments and see you next time.